So first of all, thank you very much for attending so far and now the roundtable. I'm perfectly conscious that the roundtable is between you and lunch, and that this was a long set of presentations. So let's try to make it lighter and enjoyable, so you don't feel that you are losing time for lunch. Eitan will assist me in some of the topics. The idea of the roundtable is to cover some high-profile topics that are currently very discussed around the world, and then obviously I would like also to understand from your side how these topics and other topics might influence the Israeli market, and how obviously we can assist. So the three topics that we will look into during the roundtable are how risk models are now evolving, considering that most of the risk models that you have and the world has in place were developed based on historical behavior before the pandemic. Meaning there was this pandemic. I mean, it's not the first pandemic that the world faces, but it's definitely the first pandemic on the modern world. And obviously, there is not a lot of experience on how to react, and especially the financial services, how to manage the effects and the impacts of pandemic. Now, that pandemic also generated some other impacts, like the supply chain disruptions, that again will impact the way your customers, the ability of your customers to pay on their commitments, to invest, to evolve their business. So again, revision of the models. And so the first topic I would like to focus is exactly how you see and how my colleagues have been discussing around the world the evolution of the current risk models in the different aspects: credit, provisions, capital, etc. The second topic is more about how the recent regulations will impact your business, and how you are preparing yourselves to those regulations. And the third topic is, was already mentioned by Sumit on the last presentation, relates to climate risk and ESG, and obviously how the world is preparing to that new reality, to prepare to be net zero, to how the market is organizing himself to address that important challenge. Eitan, I don't know if there is any other topic that we should also cover during the roundtable.
No, I think it's enough.
Unless any additional elements from you, meaning that again, because we can,
we are like the horses, right? So we go ahead straight, but again, it could be nice to hear also from your side what are potential additional topics, so that we can include them and we discuss with you our view and what other customers are doing.
So you have a question or a suggestion?
Regarding a customer point of view, visibility is very important. So how we can reflect to our customer as a bank the level of risk when we are using such a complex models environment.
יש עוד נושאים שמישהו היה רוצה להעלות? שהם יתייחסו אליהם?
Okay, so maybe we start on the first question, and obviously we'll include your comment. Maybe first, more global perspective. So I know, you have global responsibility, traveling and talking with customers globally.
Yeah.
What you have seen and
Yeah, I mean, I think that we have all experienced the fact that with the pandemic, we were in the very short term, we needed to, again, revise our model, and especially the logic that we were using for new customers. Because, again, we had to take into consideration, on one hand, that the business was completely disrupted in that short term. And again, on the other side, there were multiple stimulus from the government that was anyway impacting and somehow reducing the usability of the data to predict models, because somehow the data that we had in the time series were, I mean, going in a certain direction, not aligned on the business in that moment. And on the other side, the stimulus from the government were anyway, I mean, applying some floor to the let's say also to the credit worthiness of our final customers. So in general, the point was, okay, what we could do in the short term, but now the point is the short term is over. Now we are back to a decent situation. And when I say decent is that, again, now we have many other issues ongoing, many other external factors impacting the let's say, the business of our customers, depending on where they work, the type of line of business, the type of activities that they are performing. So there are many factors changing basically and impacting the creditworthiness of our final customer, both for retail, for corporate, SMEs. So the point is, on one end, we need to be able to quickly review the models, adapt the models to the new data that we are collecting. It's extremely important to include additional data from non-traditional sources where we need to apply quality checks to be sure that we can consume them, include them in our models, and again, somehow extend our models. Obviously, advanced analytics like machine learning and so on can help. We know perfectly that the regulators are not happy that we use this type of algorithms. So the logic is also how we can provide, let's say, interpretation of this type of models. So at least to be able to use them as a sort of benchmark. And we are doing it massively, especially for the origination models and for the collection models, where we have more degrees of freedom. The point is that, nice, but then how we can guarantee the usability, again, the traceability of all these models. And again, we cannot, the point is always, do we want to have a super skilled resources? So data science that can go and do whatever with a very limited control from the bank. And again, then if for any reason they leave the company, you don't know how to handle what they have done, or otherwise try to invest for the bank and build an asset. So allowing a collective contribution. Obviously, this is, again, is a completely different paradigm. So banks are deciding in a direction or in another. But again, I think that what we have seen is that due to the pressure that we have on one end from the business, because all these political scenarios, macroeconomic scenarios are generating a lot of pressure on our models. So there is a need to quickly review them, revise them, get new data, additional data, but keep a coherence between these models. And on the other side, again, we have anyway the supervisor asking to document and automatize as much as possible, basically, also the validation process. So I think that these are the main focus area that we see in globally. Of course, there are peculiarities in each territory, but I think that these are the main aspect that we see.
Well, I'll just add one other thing to. So first of all, the point you made about somebody built a model, left the firm for some other bank, and then how do you maintain that system? That's a real problem that a lot of institutions face on bringing in these. So that's a real concern, and not having a system is a real problem. Number one. But the additional point I want to make is that, at least in the US, what I see, and I'm sure it's elsewhere, is that the credit extending credit is just not a bank issue anymore. There's a lot of other institutions like fintechs which have started giving loans and credit. And so it's not only a question of, if you don't do this, it's not a regulatory issue only, it's also a competitive issue. So if you're not able to generate, but you have to do it obviously mindfully, so you don't give credit to anybody, but when you give the credit, if you are not able to move fast enough and evolve enough, you're not going to be competitive enough, which is a real problem. So that's a big change in the market space.
Thank you. Maybe we can move to the. I don't know if there is any comments, any question from the audience regarding. I mean, the Israeli market obviously is quite mature as comparing with general markets around the world, and has, as Sumit was pointing out, you have the traditional banks which face some specific challenges. You have the fintechs that obviously are also bringing new approaches to the market. Do you see the same challenges? How you are looking at the modeling and how to use effectively the scoring models, provision models, capital models in order to obviously not only satisfy the regulator but also to help you on managing risk and managing your institutions going forward? Anyone want to comment? Yes.
So 2 points. I come from fintech, so thanks for mentioning. So it's a more flexible, of course, environment that could update the models quicker. I have a question about, we always talk about the disruption right now because of COVID, but in a way, our models have always, disruption has always happened, maybe not in, such a scale. Do you see a movement towards other non-historical, like actually other models, like bubble theories and other, algorithms that are coming into play much more than before? Definitely. That's clearly a trend. And as you said, this disruption was quite a big one. But there are always some level of disruptions, and there are always also some level of evolution in the markets, right? So we, from the discussions we've been having around the world with risk departments, there are definitely a lot of focus on understanding other techniques besides the traditional historical-based techniques that can help. Now, artificial intelligence, machine learning is one key, but as you pointed out, there are other areas like different algorithms, different approaches, which in the first level come as a challenger to the existing. So the first step is to challenge the existing models, and obviously then understand if indeed they can give you better performance. So again, it comes back to the point that you have to have the flexibility, you have to have the people that have the knowledge and have the understanding, a broader understanding of the possible algorithms, the possible types of models, but you also need to have the right infrastructure so we can react quickly. As you pointed out, fintechs, by definition, have more flexible environments, but obviously more traditional banks will have to create that level of agility.
Yeah, so the logic of having a sort of model factory where you can challenge multiple approaches and see again what are the benefits, and then decide how you want or to improve the more traditional models or deploy the new ones, but again in a way where you can at the end converge and be sure that the rules that you are applying can be justified again to the supervisor, to the investors. So there are anyway some constraints that you need to keep under control, and the logic is being sure that again you don't have constraint on the technology, on the type of models, but then you can provide again a coherence between the rules that at the end you will apply to the market.
Any other question? Someone from the more traditional banking like to challenge? Or that we have already a comment from the fintechs? Otherwise, we can move to the next topic. As I was introducing before, there are several regulations that are coming to play, some related with climate risk, ESG, as you know. Some others are updates on the traditional regulation regarding capital, like the Basel 3, 4, depending on the country you are, can be designated 3 or 4. So
my question to my colleagues is how you are seeing in general, the financial services reacting to those regulations. It's true that they were postponed, but there is still a deadline.
Yeah, no, absolutely. I think that this is, I mean, as usual, what we see is that the regulation is, again, driving or allowing the banks to do investments, to modernize the platform. So somehow it becomes more a sort of excuse to have a budget to do something that we really need as a bank. So, for example, for Basel IV, true, this has been slowed down, but now what we see is that exactly as it was happening with the larger banking groups, I don't know, Intesa or many other ones, they were basically leveraging that need to invest and modernize the platform of the regulatory capital. Why? Because they don't need it just for the regulatory requirements. But again, they are using it to monitor the portfolio, to apply risk-based pricing. And again, many of our customers leverage that investment to be able to run daily basis the regulatory capital calculation at granular level on multiple scenarios. So basically the logic was I have to do something, so I have to ask a budget. Let's not use that budget simply to be able to cover Basel IV, but let's leverage that budget also to modernize the platform and go to a high performance calculation engine that will allow us to monitor the portfolio, run all the simulation daily basis. So this has been, again, I mean, we can share all the details, but this has been really a trend before the COVID. Then, of course, this slowed it down a bit, but we see that this is already restarting faster than before because obviously they have postponed the activities and now they have to rush to recover at the time.
No, I agree, and this trend has been there for a while. And as I was saying earlier on, this how the bank does this operating plan and how it does its liquidity management, how it does its regulatory capital, how it does allocation and profitability. These are all converging. Now, I want to go back to the point that Martim said about ESG. So there's an interesting point that some of you may already know that in the US, there is a ESG rule coming up in August. There's already, the comment period is, I think, over now. It was out for a while. Well, people will have to provide information. So now, right now, it's more informational, but at some point, there's already a discussion about how to compute some numbers which will be used to essentially understand whether the capital the bank holds is sufficient to cover for the ESG risk exposure. It's in discussion, but the discussion already started. So it's a constantly evolving process. It's not a standard process. The important thing to remember is that, as Anselmo was saying, that I think we should not think about this only as a regulatory task that we have to meet, and then the next one and next one, but think about this more as a framework. And if you get the framework right, it should be able to incorporate, of course, with some investments and thinking, but it should be able to incorporate that. And that is the mindset that we have to generate. So that's why it's important to break away from silos and try and create a view where the risk and finance functions can come together and you can get a proper view and you can run the bank more efficiently. I think that's the trend in general.
Ethan, any comment from the Israeli market?
On ESG, I had a short discussion with the supervisor. Probably his reply was not official, but he said it's a very interesting topic for him in Israel, for Israel, but it will be here a long journey.
Yeah.
A long journey.
Yeah, indeed. Actually, if I may comment on some of my interactions with banks and regulators around the world, we see a sort of two lines of trend, if I can say that. Europe in general and ECB in particular, but also PRA in UK, have looked at and are looking at ESG and climate risk in particular from their perspective as a way to use the financial services as the catalyst for the change. So ECB and PRA are issuing regulation around climate risk, and as you probably know, there was a recent exercise on stressing climate that banks had to fulfill. But there's also a publication now in EU taxonomy, so banks can properly classify their portfolios according to a standardized approach that obviously will then be used by ECB to ask the reporting. So the reporting would be aligned with that taxonomy that was recently published. And the general idea that comes from the political logic, so the governments are thinking if we regulate financial services regarding ESG and climate, then financial services will start pushing the change, meaning each financial service at the end of the day decide where the money flows. So if financial services have the incentive to put the money on the right bets, then that will provide the change. On the other hand, as somehow usual, the US is looking in a different perspective. So the US is not, let's say, going as fast as Europe on regulations, although as Sumit was just mentioning, SEC published recently a draft of the regulation and is obviously looking at it very thoroughly. But in US, the push comes from the stakeholders. It's the customers that are asking the banks about their position on climate, on ESG. And the new generation, I don't know how many of you have children in this audience, but I can tell you my personal experience is that the new generation will do business with companies they recognize as companies that are responsible, that are trying to do the right thing, etc. And so in US, that's kind of the trend, if you like. It's more the customer and the investors that are pushing the agenda on ESG. So obviously this is a sort of generic comment, but just to introduce the idea that it partially will come from the regulation, but not everything will come from the regulation. And we see financial institutions clearly making a plan and a path to, as Eitan pointed out, is a journey. It's complex, and I will ask now my colleagues to complement, in particular regarding the complexity.
Yeah, I think that this is again because on one hand we have we receive a general idea of what we have to achieve, but again, as you were saying, Eitan, this is a long journey because again you need to go from data, models, processes, internal policies. So it's for sure extremely complex. Now the point is again, we need to basically slice the problem, right, and try to understand how we can start. And again, also the large institution. I mean, we were in conference with, I don't know, Wells Fargo from US, HSBC. What they're saying is that we have to start because again, we don't know yet what we don't know. So the point is we need to start collecting the information, generate a process to orchestrate the collection of the information and also the accountability of the information that are collected. And then we have to start evaluating the potential impacts on the balance sheet due to these climate scenarios. And again, without let's say, the expectation to do it and get it, because that's not the point, but the point is really start embedding this culture in the company and have resources that are more and more involved and shifting a bit the mindset of the people in this direction. Now we have experiences in multiple territories. Obviously, as Martin was saying, US and UK, they are under pressure because the regulation is pushing. So we have cases where we collaborate with the banks there in these steps. also in Asia, there is a push, especially I would say in Japan, and it's not the case because if you consider in the past years how many climate events they had with flood. I mean, I don't know if you know, but again, the insurers there were extremely under pressure because the floods that they have in the last 3 years were completely damaging the insurance business because they were so impactful on the business and on the corporate and also in the large corporation that somehow for them it's of course there is somehow a government target to achieve some goals, but on the other side it was for the country also a way to shift the way they do business to incorporate climate in their evaluation. So there are multiple things that we are doing. In many cases alone, I mean, we have again a set of experts working on these topics. In many cases, also collaborating with partners. That could be whatever the consultancy company that you have in mind. But again, the point is we need to start to understand the business, the data that are missing, how to collect the information from both outside providers, but also internal information, map them to the portfolio, map them to the operations, and then build the flow, allowing running simulations, as Sumit was mentioning in the previous.
Let me share one quick story. I think it's kind of interesting. So, two quick stories and one observation. So, I think I mentioned earlier on, very recently, I won't name which bank, but very large global bank, European bank, got into deep trouble because their asset management wing was claiming some of their assets to comply to a certain ESG standard, and then they ran afoul of the regulator that their claims were actually not true, and they ended up being in trouble and fined heavily. And a similar bank in the US has run into the same issue, right? So these are just two examples. There are many, right? So the point is this is a case where ESG is just not a question of risk. It is also being considered a profit driver for many firms, right? Because of what Martin was saying, younger generation and other people are more focused on these elements than others, perhaps other generations.
Do you want to say something?
But the question is that these can bring in a lot of revenue, and therefore people are getting ahead of themselves in terms of what they claim and what they can prove. So that's an operational risk that has to be understood through models of data and so on. So controls are important, right? Number one. Second example I was to give you is that Tesla. We all know Tesla. Tesla got dropped out of the ESG index recently, right? And you scratch your head, Tesla is an EV, one of the biggest, the biggest EV. How can they drop off? They didn't get dropped out of the ESG index because of environmental concerns. They got dropped because of the social concern, because they found that there was, they were not paying enough to certain groups, and that's why they got downgraded. So here's another case where, we think about something, but it's not quite exactly the same. So I think the point that I'm trying to make is that these are out there. These are new risk factors. How we understand them. Of course, if we take on risk, we make more return, but we have to be able to understand what that is through data and models and controls. And this is just going to keep evolving, and the capital and other things.
Yeah, definitely. I mean, currently, one of the biggest challenges, if not the biggest challenge on the climate risk and ESG, is data. Is how do we collect the right data, and secondly, how we do relate that data with our data. How do I know the profile of my portfolios, and the risk of getting wrong, like for example, the stories that Sumit was talking about, where I classify my portfolio and I say, okay, these assets are green, these assets are brown. If I don't get the data right, if I don't do the right process in place, I might be accused of greenwashing tomorrow. People say, oh, wait a minute, but your green fund is not actually that green. Now, this has impacts because I might be investing, or I might have a counterpart that looks green, but then he has suppliers. And I can be impacted by the suppliers of my suppliers. And that can be a big story. And I tell you, from some of the stories that Sumit was alluding to, the cost that these banks have today, the reputational cost surpasses largely the fines from the government. So ESG, in one side of the story is the compliance, okay, but the other side of the story is really the as I was saying before, the stakeholders, the customers and the investors, the focus they put on that and how they look at you and how they assess your real position. And if you don't balance environment with social, with governance properly, I mean, Tesla and other examples might be fantastic environmentally, but if they have not the proper governance put in place, why should we care? Right? And you know, this is a global market. Volkswagen is claiming that they will be better than Tesla in just a couple of years. So everything is moving, right? Eitan, any words
That's
on
fake
the
news.
Israel?
Tesla is number one.
I'm skeptic on that one. Any comments from your side, from the Israeli market?
I think the Israeli market traditionally is a bit a follower after the large economies, and that's natural. So we'll wait here for the success in other, and then we'll try to imitate as fast as we can. I think also the local regulator follows up sometimes after the European one, I hope sometimes after the American one, but he will not be the one who charges in the front.
On the other hand, Israel is known to be quite innovative in technology. So
right, it is, and the explanation for that is that the huge fintech and startup industry in Israel, and it is huge. Just today I heard they want to set a target that a fifth of the workforce in Israel by 2035 will be high-tech, 700,000 people. Okay, that's the plan of the government, 20% of the workforce being dedicated to high-tech. But the market of this high-tech industry is not the local market, it's the American market, okay? The American market is a self-sustained market, and they produce enough, they have enough buying power to sustain any industry they create. But here, this with targeted toward, when it comes to high-tech, toward the American market, maybe the European market also. But in the regulation side, we are followers. So it's two sides of a coin.
but exactly as you pointed out, since your focus, especially in high-tech, is international markets, it's important to be aligned with the regulations and the practices on those markets.
Yes,
And those markets are quite demanding.
yes,
And that's what
definitely. Can we wrap up?
I think we can wrap up. I hope that this was not too boring, that you are not upset for keeping you from the lunch. Happy to get any final questions from the audience. Otherwise, we'll have the chance to discuss some of these topics during lunch for sure. Thank you very much for attending. Eitan, I'll pass you.
Yes, thank you. So I would like to summarize. First of all, thank my colleagues from SAS, Martim, Sumit, and Anselmo for coming over. And any ideas that you think and you derive from this day, we will be happy to continue and follow up the discussion. Okay, and this will mark the next visit of our colleagues to Israel, and they like very much to come here. So please don't hesitate to think again about what you heard here, and come up with questions and ways of how we can help you take your existing SaaS platform and innovate it and modernize it to give you more benefits and solve more business issues, okay, for the benefit of your banks and organizations. תודה רבה.